Welcome to The Explainer. Today, we're doing a total mindset shift. We are moving away from that tactical, day-to-day standard costing, and we're zooming out to focus on long-term strategic thinking. We're going to equip you with the absolute ultimate advanced performance management toolkit. So if you've ever looked at your organization's metrics and thought, we're really missing the bigger picture here, well, you're in the exact right place. Let's get into it.
To really grasp the core problem we're solving, we have to look at the stark contrast between these two approaches. Traditional performance management is essentially what we've always done, right? Getting completely bogged down in short-term financial variances, standard costing, basic divisional metrics. But let's be real, the modern business environment demands so much more than that. Advanced Performance Management, or APM, solves this exact issue. It completely shifts the focus to long-term strategic alignment, integrated reporting, and actually maximizing shareholder wealth. And it does this by bringing in non-financial and stakeholder metrics. Ultimately, it's about driving the right behaviors, not just making sure the books balance at the end of the month.
So here is our roadmap for today. We're going to map out 4 highly interconnected strategic frameworks. We'll hit the balanced scorecard, the performance prism, the building block model, and value-based management. And then we're going to tie the whole shebang together with the absolutely critical concept of strategic alignment.
All right, let's jump into tool number 1, Kaplan and Norton's Balanced Scorecard. This is basically your go-to framework for aligning high-level strategy with your day-to-day operations. Now, instead of just obsessively asking, did we make money? The balanced scorecard forces us to take a step back and evaluate performance across 4 distinct perspectives. First up, financial. How do we look to our shareholders? We're talking ROI, cash flow, the usual suspects. Second, customer. How do they actually see us? We need to track things like satisfaction and retention. Third, internal business processes. What must we absolutely excel at internally? Think cycle times or defect rates. And finally, learning and growth. How can we continuously improve and create value? This is all about employee training and pushing innovation.
But here is the really crucial part. These 4 perspectives, they don't just exist in a vacuum. They form this beautiful cause and effect chain of value creation. Think about it. Better learning and growth directly improves your internal processes. Then, those smoother, faster processes are exactly what satisfies your customers. And ultimately, those happy, loyal customers are what drive your financial success. It's like a domino effect. You simply cannot reach that top financial step without building a solid foundation first.
Moving right along to tool number 2, the performance prism. This one is all about adopting a truly stakeholder-focused strategy.
So what's the big difference here? Well, what really sets the prism apart is its massive scope. While the balanced scorecard focuses heavily on shareholders and customers, the performance prism steps back and says, no, we need to evaluate our strategy through the lens of all our stakeholders, literally everyone involved. That means actively measuring our relationships with our employees, our suppliers, regulators, and even the local community. It is a completely comprehensive 360-degree view of your strategy.
Okay, let's look under the hood at how this actually works. The prism operates on 5 facets. We start right at the source. What do our stakeholders want? That's stakeholder satisfaction. Then we ask, what strategies do we need to actually deliver that? Next up, what processes do we need in place to execute those strategies? Fourth, what capabilities, the technology, the infrastructure, the skills, are required to support those processes? And finally, and this is what makes it so unique, stakeholder contribution. Meaning, what do the stakeholders give back to the organization in return? It reminds us that this is very much a two-way street of value.
All right, on to tool number 3. This is Fitzgerald and Moon's building block model, and it's a framework explicitly engineered for service organizations.
Since service outputs are, way less tangible than manufacturing widgets, and customer involvement is super high, this model breaks performance down into 3 clear dimensions. At the very top, you have the ultimate results, your competitiveness and your financial performance. But those results are driven by the second dimension, the determinants. This is your secret sauce: quality, resource utilization, flexibility, and innovation. And finally, to actually measure any of this stuff effectively, you need the third dimension, which is standards. Your performance standards absolutely must have ownership from the staff, they have to be achievable, and they need to demonstrate equity. Basically, they have to be fair across the board or the whole system falls apart.
Which brings us to tool number 4, value-based management, or VBM. This is an approach that is purely 100% obsessed with maximizing long-term shareholder wealth.
It all boils down to this primary metric, economic value added, or EVA. And the formula here is a real game changer. It deducts the true cost of equity capital from your net operating profit after tax. Now, why does this matter? Because it's a massive shift away from traditional accounting profit. Traditional profit completely ignores the cost of equity. EVA, on the other hand, aligns your managers directly with your shareholders. It exposes whether a company's actually creating real wealth, or if they're just generating a neat little accounting surplus while quietly destroying long-term value.
Okay, we've covered the tools. Now we arrive at the glue that holds it all together: strategic alignment. This is where we connect our measures to our actual strategy.
Listen, cascading all these fancy frameworks down through your organization only works if you avoid misalignment. Your day-to-day measures absolutely must reflect your overarching strategy. If they don't, well, you're going to create what we call dysfunctional behavior. Let's look at a perfect example from the source material. Imagine your big corporate strategy is delivering excellent customer service. Amazing. But then down at the operational level, you decide to measure your call center response time in strict seconds. Well, what's going to happen? You're literally forcing your staff to rush customers off the phone just to hit their targets. Sure, you get faster call times, but your service becomes terrible. The operational measure actively destroyed the strategic goal. To align that correctly, you'd want to measure something like first call resolution rates instead. See the difference?
So, as we wrap up this explainer on strategic toolkits, I want to leave you with a really critical thought, something to evaluate within your own organization today. If your performance measures are misaligned with your corporate strategy, what dysfunctional behavior are you inadvertently creating? Are people gaming the system? Is there short-termism? Are they padding the budget? Think about the frameworks we explored today, take a hard look at your metrics, and ask yourself, are we truly measuring what matters? Thanks for diving into this with me. See you next time.